Hi, this is Joe Mellon. I'm in the life insurance business in Houston, Texas. I've been in this business since 1966. Around 2005, I found myself in another business, a very exotic end of the life insurance business that not too many people know about. It's called the life settlement business. A life settlement is the sale of an insurance policy to institutional investment groups. That would be pension trusts, mutual funds, crime banks. The biggest player in crime banks is Credit Suisse. And a life settlement is the sale of an insurance policy to these types of buyers. Actually, any kind of life insurance policy can be settled. Essentially, there's two types of life insurance: term insurance and permanent insurance. Now, there's different types of term and there's different types of permanent. For example, there's 10-year term, there's 20-year term, there's even 30-year term. On permanent, there's whole life, there's universal life, there's survivorship life, there's variable life, all types of permanent insurance. But essentially, there's two types of coverage. A life settlement is the sale of any of those types of life insurance policies, including term insurance. Now, you might wonder to yourself, why would anybody want to buy a term insurance policy? Because at some point in time it's going to end. But a term insurance policy is also convertible, usually right up to the very end of the policy. So if it's convertible, that means using a one-page document, you can convert that policy to any type of permanent insurance that company offers by simply filling out a one-page form. No medical questions, no underwriting. It's guaranteed convertible. And the reason that a person would be interested in buying a term policy is because they will convert that policy at the time of the sale. And they'll take that policy down the road and pay the premium as long as you're alive. You, on the other hand, get paid cash for that policy up front, and you can do anything you like with that cash. For example, you could buy an annuity with it that would pay you a lifetime income. You could buy a long-term care policy. If you're still insurable, you could buy another life insurance policy with that. So the money that comes to you from a settlement stays in your pocket, and you can do anything with that you like. A policy could be sold for any number of reasons. For example, sometimes the reason for the insurance coverage just goes away. Sometimes a person is no longer able to pay the premium. Maybe they don't have the cash flow they had. There's any number of reasons why somebody might want to sell an insurance policy. I can give you a couple examples of recent settlements that I've done. One of them was an attorney that I met at a client's brunch party. I'd never met him before. He was a pretty well-known local mediator. I had a conversation with him, and after some time went by, I discovered that he had a 10-year term policy for $500,000, and he was in the 9th month of the 9th year. In other words, that policy, the ink was going to disappear in 3 months. So at his age 69, the policy had 3 months to go, and it was still convertible. So I explained settlements to him. We filled out some paperwork, so I got his medical history and details about the policy. And on a settlement, we do what's called a reverse underwriting. That's an underwriting that's designed to try to determine somebody's life expectancy. And that is how you value a policy. There's a few other things as well, but that's the most important way you value a policy. What is the insured person's life expectancy? The way that case ended was I was able to get him $45,000 cash for his $500,000 life policy. Now at his age 69, his life expectancy was about 20 years, maybe 22 years, typically, or statistically. Able to get him $45,000 in cash for that policy. And what he did was he gave me the policy, he signed a conversion form, we converted that policy from term to a permanent policy, in this case universal life, which is the lowest cost permanent insurance. And the buyer, which in this case was a bank, took that policy, paid him for it. Now they have the policy, they become the beneficiary. All of the buyers are institutional. Right? Another example is I was giving a speech at a Rotary Club's luncheon not too long ago. And after I got done with my talk, and the Rotary people tend to be a little bit older, and so they're pretty interested in that type of thing. After I finished talking, I sat down and a fella sitting behind me tapped me on the shoulder and he said, I've got two policies that total $950,000. He says, I can't pay the premium on these policies anymore because I'm retired and I don't have any cash flow. He was 76 years old and he'd been retired for some time. He told me that if he surrendered those two policies to the insurance company, that he would get $90,000 in a surrender. And he asked me, do you think you can get me more than that? I said, I don't know, let's find out. So I had him fill out the paperwork, got him underwritten, and found out that he had a life expectancy of 6 years. And I was able to get him $387,000 for those two policies that he was ready to surrender for $90,000. Now the average settlement today is 22% of the face amount of the policy. So on $1 million policy, that's $220,000. Some settlements go up to as much as 50% of the face value of the policy, and some are a lot lower than that. It depends on a person's life expectancy. Now things have changed since 2005 when I got in the life settlement business. Back then I could settle a policy on a 70-year-old that was in good health. Today that's not possible. They've revised and revised their underwriting guidelines to look back at policies that they bought in the past to see how good their underwriting is. Believe it or not, their underwriting is so good that when they look back at policies that they bought in the past, their life expectancy is only off by plus or minus 4 months. Now that's a statistic. They can't look at me or you and tell us how long we're going to live, but they can guess at it by taking, say, 1,000 or 2,000 people with our profile, putting them in a bag, shaking it up, and they've got their numbers. They know. It's just like Las Vegas, knows percentages on winning and losing. Obviously, the larger the policy, the larger the settlement. Buyers tend not to be interested in policies that are less than about $200,000. But whether they're term insurance or permanent insurance doesn't matter. Right. Here's how the underwriting process works on a life settlement. First, remember that the value of a policy is established by two big things. One of them is the health of the insured person. So the life expectancy is what they're looking for. Obviously, the shorter the life expectancy of that person, the larger the settlement's going to be. If we have a life expectancy that's in the neighborhood of, say, 12 to 15 years, I can expect a small settlement, maybe 5 or 10% of the face amount of the policy. But if I have a life expectancy of, say, 10 years or less, I can expect a larger and larger percentage of settlement. So if I'm in a 5 or 6 year period of life expectancy, then we're talking about a settlement in the neighborhood of 30 to 40% of the death benefit, the face amount of the policy. The underwriting for settlements is pretty simple. I have to have all the details on the policy. So I have a one-page service authorization that I have signed that has the name of the insured person, the policy number, the name of the company, and their signature. That service authorization allows me to contact the company and get all the details on the policy. The face amount, when it was issued, whether there's any cash value in it, all those details. The other part of underwriting on a settlement is medical underwriting. So I have a form that I send that asks medical questions. What's your age? What medications do you take? Have you had a surgery in the last 5 or 10 years? Those types of questions, so we can establish a person's medical history. Once we have that and details on the policy, we can do an underwriting, and at that point the buyers, there's many potential buyers, have a look at that. We package that up, send it to the buyers, and they make a decision as to what they're going to offer for that policy. Now the way I dispose of an insurance policy for somebody is I auction it to those buyers. I want to get the highest price I can for that policy. The way to do that is to put it out there in an auction and let them bid against each other to buy that policy. So that essentially is the life settlement business. Now there's some possibility that you have a policy, especially a term policy, that's going to end. A settlement is a way for you to recover the premium and much more. If you have a permanent policy and it has cash value in it, a settlement typically will return to you 20 times the cash value. If there's no cash value at all, There's nothing in the policy. It just has a death benefit. So a settlement pays you for that policy. So you may be a candidate yourself for a life settlement, or you may know somebody that is, for example, a parent. It's not unusual for somebody to need to raise money from some source, and a life insurance policy is typically an invisible asset. People have no idea that they can sell that policy. So if you're a candidate or have a friend or family member that's a candidate for a settlement, call me, Joe Mellum, at 281-679-5100. I'll send you the paperwork to fill out, which is fairly simple, and we'll take a look at your coverage and see whether we can get an offer on it. Thank you.